Nifty had a bull run in 2023, and it ended with a 20% return. Many analysts are considering 2024 as an optimistic year. Several factors, including the upcoming Lok Sabha elections and potential interest rate cuts by US banks, will definitely influence the stock market. This year, many small caps and mid caps provided amazing returns, and their future prospects still look bright. Today, we are going to discuss 8 stocks to invest for the long term. If you are new to my channel, please do subscribe. Also check out my playlist, Best Stocks to Buy for the Long Term. So let's get started. Third stock from our list is from the breweries distilleries sector. This stock holds 52% market share and leads the domestic Indian market in this sector. I am talking about Sula Vineyards Limited. Sula Vineyards Limited is an India-based wine producer and seller. The company is engaged in the business of manufacturing, purchasing, and sale of alcoholic beverages, such as wines and spirits. The company operates under 2 categories of business: wine business and wine tourism. Incorporated in 2003, Sula Vineyards Limited is India's largest wine producer and seller. The revenue breakup includes a significant 84% from own brands, 8% from imports and another 8% from wine tourism business. The company has a 60% market share in the elite and premium categories, and an overall market share of 52% in the Indian wine industry. The company has a presence in 25 states and 6 union territories in India. It also entered the overseas markets in 2003 and currently offers wines in over 20 countries. The company is trying to increase wine awareness and consumption and trying to enter Tier 1 and 2 cities in India. Sula Vineyards, with a market capitalization of 4,199 crores, operates with a current stock price of 495 rupees. Price to earning ratio is 46.50, lower than its sector pay ratio of 67.28. Stock price rose 50.45% and outperformed its sector by 6.29% in the past year. Debt to equity ratio of 0.36 is less than 1 and healthy. Return on equity for the last financial year was 15%. It is a good time to consider buying the stock as it is not in the overbought zone. 100% buy rating from analysts. The second stock is one of the leading defense public sector undertakings, PSUs, in India. This stock is a significant player in India's defense industry. I am talking about Bharat Dynamics Limited. BDL has a rich history of achievements, including the production of India's first state-of-the-art surface-to-surface missile, Prithvi. The Integrated Guided Missile Development Program, IGMDP, has been one of India's most successful defense projects, with all missiles, Prithvi, Akash, and Agni, successfully inducted. BDL is a powerhouse in manufacturing anti-tank guided missiles, surface-to-air missile weapon systems, air-to-air missile weapon systems, underwater weapon systems, and associated equipment. They play a crucial role as the sole manufacturer of missiles, torpedoes, and the weapon system integrator for the armed forces. They handed over the first radio frequency seeker of the Akash, next-generation weapon system, and received a substantial supply order for anti-tank guided missiles from the Indian Army. Notably, limited series production clearance was granted for the Astra Mark I missile system. The company is also engaged in the business of refurbishment and life extension of stored and deployed missiles. Bharat Dynamics, with a market capitalization of 31,132 crores, operates with a current stock price of 1,721 rupees. Price to earning ratio is 73.18 than its sector pay ratio of 41.15. Stock price rose 86.07% and underperformed its sector by 0.44% in the past year. Debt to equity ratio is 0 as the company is debt-free. Return on equity for the last financial year was 12%. The company is generating increasing cash from operations. The company is giving better long-term returns than the industry. It is a good time to consider buying the stock as it is not in the overbought zone. 71% buy rating from analysts. The third stock is from the healthcare sector. The Indian healthcare industry has been growing at a compound annual growth rate, CAGR, of about 14 to 15% since 2016. To promote medical tourism in the country, the Government of India is extending the electronic medical visa facility to the citizens of 156 countries. India's surgical robotics market is estimated to expand to hit the size of $350 million by 2025. This stock is one of the largest corporate healthcare groups in India. I am talking about Krishna Institute of Medical Sciences. The company operates 9 multi-specialty hospitals under the KIMS Hospitals brand. KIMS stands as a regional healthcare powerhouse, boosting leadership in both Andhra Pradesh and Telangana, offering over 25 specialties and super specialties, including cardiac sciences, oncology, neurosciences, and more. KIMS ensures a comprehensive range of healthcare services for its patients. Let's talk numbers. Cardiac care takes the lead, contributing 17% to the revenue mix, followed by neurosciences at 11% and renal sciences at 9%. With 67% of the financial year 22 revenue coming from the Telangana cluster, KIMS has strategically positioned itself for success. KIMS, with a market capitalization of 16,000 crores, operates with a current stock price of 1,975 rupees. Price to earning ratio is 46, lower than its sector pay ratio of 64. Stock price rose 29.71% and underperformed its sector by 2.82% in the past year. Debt to equity ratio of 0.32 is less than 1 and healthy. Return on equity for the last financial year was 20%. The company is generating increasing cash from operations. It is a good time to consider buying the stock as it is not in the overbought zone. 80% by rating from analysts. The fourth stock holds 59% market share in depository business. In fiscal year 21, this company became the first depository with more than 3 crore demat accounts. I am talking about Central Depository Services, India, Limited. This stock is engaged in providing depository services, data processing services, and others. The company operates through 3 segments: depository segment, data entry storage, and repository. The company facilitates holding and transacting in securities in the electronic form and facilitates settlement of trades executed on stock exchanges. They also have the largest number of DPs registered in the depository business. The company has 592 DPs servicing across 28 states and 8 union territories. Looking at the company's revenue breakdown, annual maintenance charges contribute 34%, transaction charges 13%, and KYC service 16%. CDSL, with a market capitalization of 19,163 crores, operates with a current stock price of 1,826 rupees. Price to earning ratio is 59.85, higher than its sector pay ratio of 38.18. Stock price rose 63.08% and underperformed its sector by 2.05% in the past year. Debt to equity ratio is 0 as the company is debt-free. Return on equity for the last financial year was 22%. The company is generating increasing cash from operations. It is a good time to consider buying the stock as it is not in the overbought zone. 56% by rating from analysts. Stock is a global technology giant with a proprietary consumer intelligence platform. This company turns ads into recommendations, helping marketers effectively connect with their potential and existing users. This stock has 21 patents filed, with 6 already granted in the US. I am talking about Affle, India, Limited. This company operates on 2 primary platforms, the consumer platform and the enterprise platform. The company offers a range of cutting-edge services, including a customer data platform for marketing automation, technology enabled by a rich patent portfolio, and high-engagement video, rich media, and native ad experiences. Affle's clientele is just as impressive, boosting names like Tata 1mg, Swiggy, Fossil, and many more. Affle collaborates with platforms like AppNext, Jamp, and RefX to amplify their reach. Affle has been busy on the acquisition front, with notable moves like acquiring 100% control in Jamp and a substantial stake in AppNext. They have a global footprint across Asian, European countries, Middle East, and USA. Affle's revenue breakup reveals that about 99% comes from the consumer platform, showcasing its strong foothold in the market. Geographically, 65% of their revenue comes from outside India, highlighting their global influence. Affle, with a market capitalization of 17,556 crores, operates with a current stock price of 1,308 rupees. Price to earning ratio is 66.41, higher than its sector pay ratio of 30. Stock price rose 22.78% and underperformed its sector by 12.36% in the past year. Debt to equity ratio of 0.07 is less than 1 and healthy. Return on equity for the last financial year was 16%. The company is generating increasing cash from operations. The company is giving better long-term returns than the industry. It is a good time to consider buying the stock as it is not in the overbought zone. 60% buy rating from analysts. The sixth stock is a key player in the power sector. This company has maintained its leadership position in power trading since its inception. This stock was established in 1999 as a public-private initiative by the Government of India. I am talking about PTC India Limited. The company offers integrated energy services, including power trading, renewable energy, advisory services, and investment services. The trading activities involve long-term trading of power generated from large power projects, including renewables, as well as short-term trading arising as a result of supply and demand mismatches. This is primarily through its subsidiaries, PTC India Financial Services Limited and PTC Energy Limited. Interestingly, 41% of PTC's revenue in the power segment comes from its top 3 major customers. The company introduced electricity trading in 2002, co-promoted India's first electricity exchange, IEX, and engaged in cross-border trade with Nepal, Bhutan, Bangladesh. PTC played a pivotal role as the nodal agency for the commissioning of the 720-megawatt hydroelectric project in Bhutan. In terms of revenue split, the company's focus is on power trading, accounting for 94%. The investment segment comprises the remaining 6%. The company would soon achieve a debt-free status following the divestment of its arm, PTC Energy, to ONGC for an enterprise value of Rs 2,021 crore. PTC India's outstandings have reduced drastically due to the late payment surcharge scheme, and it is now emerging as a company that does not take loans to meet its working capital needs. The divestment of PTC Energy is part of the strategy to exit the non-core business. PTC India, with a market capitalization of Rs 5,538 crore, operates with a current stock price of Rs 185. Price-to-earning ratio is 10.66, lower than its sector pay ratio of 67.08. Stock price rose 130% and outperformed its sector by 88.53% in the past year. Return on equity for the last financial year was 10.19%. The dividend yield is 4.17%. The company is generating increasing cash from operations. The company's profit growth is better than the industry median. Good time to consider buying since the stock is underpriced and not in the overbought zone. 100% buy rating from analysts. The seventh stock is from the auto sector. This stock holds 60 to 90% market share in differential gears. I am talking about Sona BLW Precision Forgings. This company is one of India's leading automotive technology companies, designing, manufacturing, and supplying highly engineered, mission-critical automotive systems and components. Their focus on research and development has positioned them as one of the few global companies capable of designing high-power density EV systems with lightweight designs. With 6 facilities in India alone, they supply products to top global PV, CV, and tractor OEMs. This extensive network allows them to meet the diverse demands of the automotive market. The company has secured a strong market position, being among the top 10 global suppliers for differential bevel gears and starter motors. In the domestic market, Sona BLW holds a significant market share, ranging from 80 to 90% in commercial vehicles and tractors to 55 to 60% in passenger vehicles. Sona BLW's geographical presence is truly diversified, with 26% of revenue coming from India and the rest from North America, Europe, and Asia. Their clientele includes major players like Ashok Leyland, Daimler, Maruti Suzuki, and Volvo, showcasing a strong and diverse customer base. Let Sona BLW, with a market capitalization of 37,110 crores, operates with a current stock price of 645 rupees. Price-to-earning ratio is 80.20, higher than its sector pay ratio of 40.61. Stock price rose 52% and underperformed its sector by 3.88% in the past year. Debt-to-equity ratio of 0.09 is less than 1 and healthy. Return on equity for the last financial year was 17%. The company is generating increasing cash from operations. It is a good time to consider buying the stock as it is not in the overbought zone. 53% buy rating from analysts. The Indian government's Make in India push in the defense sector has meant that there is a move to source equipment locally. This is good news for public and private companies in this sector. The country's indigenous purchases, which were at 54% in 2019, are expected to go to 75% in 2024 and beyond. In the fiscal year 2023, the Indian government approved the acquisition of around 2.7 lakh crore worth of defense equipment with 99% domestic sourcing. India's capital expenditure towards defense has grown at a compounded annual growth rate of 9% from 2010. The Seven Stock is a leading player in the construction of all kinds of vessels, repairs, and refits of all types of vessels, including periodic upgradation and life extension of ships. I am talking about Cochin Shipyard Limited. Incorporated in the year 1972, this company has built and repaired some of the largest ships for its esteemed customers across the globe. It has exported some 45 ships to various clients outside India. Cochin Shipyard Limited is India's first greenfield shipbuilding yard and the only yard that can repair air defense ships. The company has ship repair facilities at Kolkata, Andaman Nicobar, and Mumbai. It has an international ship repair facility at Kochi and has recently acquired Tebma Shipyard at Malpe. Their clientele in domestic markets includes the Indian Navy, the Indian Coast Guard, and the Shipping Corporation of India Limited. Its international clients list consists of the National Petroleum Construction Company, the Clipper Group, Vroon Offshore, and Sigba as. The company's revenue breakup showcases a diverse portfolio, with approximately 69.5% generated from the indigenous aircraft carrier, 13.5% from other vessels, 16.6% from ship repairs, and 0.4% from the sale of scrap and shipbuilding financial assistance. Cochin Shipyard has secured its position in the deep-sea fishing vessel through the strategic acquisition of Tebma Shipyards Limited. Cochin Shipyard, with a market capitalization of 17,690 crores, operates with a current stock price of 1,350 rupees. Price-to-earning ratio is 41.15, higher than its sector pay ratio of 38.24. Stock price rose 148.62% and outperformed its sector by 88.85% in the past year. Debt-to-equity ratio of 0.03 is less than 1 and healthy. Return on equity for the last financial year was 6.88%. The company is generating increasing cash from operations. The company is giving better long-term returns than the industry. It is a good time to consider buying the stock as it is not in the overbought zone. Remember, always conduct thorough research before making investment decisions. I hope you found this video informative and subscribe to our channel for more informative videos.